Nick Holmes is head of Global Placement Continental Europe for Middle East and Africa, with responsibility of the retail and wholesale placement operations at Marsh. He's a member of the Continental European Executive Committee and a member of the board of Marsh Turkey. And last but by no means least, we have Mukader Erdonmez, who's a member of the Board of Management of HDI Global SE, where he's responsible for liability, legal protection and cyber insurance. You joined HDI very recently on September the 1st this year, and before that you were with AXA. So while you are watching the discussion, please feel free to send in your questions because at the end I will be very happy to transmit these questions. They will be answering them live. You can participate in this discussion using the submit question button all along the session. So I'm going to start off now with you, Henning. Could you give us your insights based on the hardening of the market that you have observed? Henning.
Yeah, thank you. And good morning from my side as well to everyone. It's great being part of this virtual session here. Obviously, we would have all preferred being physically together, but hopefully that's soon then taking place with the next meeting. So thank you again, and especially as well as this is my first FERMA in my new role, so it's a pleasure being here. So I've been asked to give a couple of comments from my side as far as hard market in the insurance sector, and with a view on capital base and a view on global results, consolidation in the market, and also on the losses, specifically on the COVID-19 impacts and future loss trends. So if we look first at the capital base of the P&C carriers, it's evident that we came off the heels of end of 2019, where we saw a very solid capital base and solvency ratios, and over the course of this very difficult year so far, we saw that on the peak of Q2, beginning of Q2, this capital surplus basically had been diminished by almost 20% due to the investment impacts, and expectations basically that this will not stay that extreme, but that we will see basically like for like, if you compare 2020, end of 2020 with end of 2019, probably a reduction of 7% in terms of capital. So that's obviously quite severe. It's not a dramatic situation, but it just shows how vulnerable the 2020 year basically is, but it shows as well how resilient the market is. But it shows as well that obviously with earnings we had over the last couple of years already, and earnings this year, that in the industry, in the P&C industry, it's difficult for most carriers to make money, especially on the industrial insurance, but also on the reinsurance side. Earning cost of capital or earning a return has not been possible over the last 3 to 4 years, and certainly not this year, which obviously leads into the situation of the hardening market. Dirk mentioned it before already, that this has been already the discussion, or the hardening market has been already the discussion end of last year. So it's not a surprise that obviously this is a continuous journey we are seeing. We see as well, or Fitch is expecting that this year, due to COVID alone, we will probably see in the P&C market across all carriers an impact of roughly 4% combined ratio points just due to COVID, probably NatCat wise, and severe losses from riots and other fires, wildfires. It's probably another 4%, 3.5% to 4% we will see there. So it's quite a tough year from an earning perspective and from a capital perspective. But on the other hand, I think the positive is that we saw quite some resilience in the market. I think what is fair to say as well is that the reserve increases we saw on the long tail lines were just basically as well a result of the soft market and over the last couple of years. So it's clear that the rate increases we are seeing at the moment are necessary. So let me comment quickly on the rates. I think that's it goes without saying. It's not a secret. I've been asked as well to comment quickly on this. I think we see over the course of the last 18 months basically continuous increase on the rating side, on the rate side. This rate strength and increase is increasing as well quarter by quarter, which is obviously from a carrier perspective good to see. But on the other hand, we need to be obviously mindful and cautious as well to what direction that will continue. Maybe briefly as well, a comment to new capital coming into the market, because obviously we see the hard market as a result of earning difficulties over the last couple of years. We see obviously that rates are increasing and that we had an impact on the capital side, but that means on the other hand as well that there's an opportunity in the market. And that's clearly seen as well with an influx on capital. On the capital side, so we saw the first half of the year roughly 20 billion coming in. There's probably more to come. That's a mix when you look at it of capital backing existing organizations and also capital backing startups. I think it's a good sign, if you ask me, because obviously competition is always good for a market. But it shows on the other hand as well that markets are obviously expecting to produce a return. Capital is not just coming in for, again, not earning. I think that's a clear sign as well. So I think the expectation in terms of the market hardening and this continuing is probably pretty evident as well. But again, I think it's a positive sign that capital is coming in. I think what we will see as well, Dirk mentioned that already, is that there is obviously a higher use expected of captive capital. I think that's we all need to be mindful of that, especially we as carriers. When we talk about hardening rate and hardening market, we need to obviously make sure that our value proposition is good enough, is solid enough to make sure that there is a demand for our product, and we are not seeing that, especially on the industrial side, captive is increasing to where we would not be allowed to make a return. From a consolidation perspective, I think it's interesting. We don't see from a carrier side too much large company consolidation. It's probably expected on some of the fronts, especially on smaller carriers due to solvency rules we are having and other impacts. But I think what's more interesting at the moment to see really is the consolidation on the broker side. I think that creates, especially on the global side, when you see the two large ones going forward, that obviously creates also room for new entrants, and especially on the second and certainly more national broker side, we see that there's an uplift basically on their end, and there's certainly as well room for niche players coming into the market. So I think that will be probably an interesting development over the next couple of years as well, and probably good for the market as well when it comes down to having more offerings. Maybe briefly on the COVID side as a comment, I think we all know that obviously we have to look at COVID from two perspectives. One is the insurability of and our product going forward, and what is the lesson learned here. And then obviously there's the second one. Dirk mentioned it as well. We are still right in the middle of COVID. We still see loss developments on the COVID side, and nobody really knows to the full degree what does that will mean. I think when we stay quickly at the numbers, when we look at the overall loss estimates in terms of insured losses, there's a wide range of 30 to 100 billion, even in excess of 100 billion. When you compare that with what so far has been reported by carriers, I think you will see that there's quite a difference. I think as at the first half of the year and results which were shown for the first half of the year, there's roughly, if you add everything up, 10 billion of insured losses reported by carriers. Again, this against an expectation of 30 to 100 billion shows that there is quite a journey we will have ahead of us over the next couple of months and years when it comes down to how these losses will really materialize. I think the second part of COVID is, and we will have a discussion probably today as well, is about the insurability and what are we doing going forward with these exposures.
Just briefly, if you could, Henning, just in 1 or 2 sentences.
Absolutely. Yeah, absolutely. So we will discuss this. I think what's important is that we find a solution as the industry in terms of these losses going forward. And with that, I conclude, and we'll probably have enough time to make my plans. Thank you.
Perfect. Okay. Thank you very much indeed for those insights. We'll come back to you in a minute. Mukada, we all know obviously that the market for industrial insurance is hardening both in Europe and beyond. So this is a very challenging phase for all the market players, especially for policyholders. What do you see as the main drivers for this situation? Mukada.
Well, thank you, Alex. Also from my side, a warm welcome to everybody. For us, it's when we look at the situation, and I don't want to repeat a lot of the things Henning already mentioned, we want to look at it in 3 portions, right? So a little bit on what has happened and why we are actually here. So what are the main drivers and what are the reasons for it? And a lot of that is really congruent with what Henning already said. But nevertheless, I think this also shows us that this is not a one single company issue. It's really an issue of the entire market, right? From that perspective, when we look back and look at the last 10 years, we see on average in our core markets a rate reduction of 47%. And at the same time, we see an increase of capacity of more than 30% on average, as well as some developments which are really concerning on the loss side. So from that point of view, when we look back over the last couple of years, we see a significant increase in loss trends, being it on the net cat side, being it on the liability side. And this in combination with the rate reductions, as well as the widening of coverage and the widening of the exposure we're actually seeing, that bring us over the last years in a situation where, as already mentioned, we also not have made money. So if we look at our point and we see like what is our expectation toward our returns on equity, we're calculating between 8 to 10%. You might argue this is a lot, but looking at the German DAX returns over the last years, they're hovering around at 13 points. If you look at the German mid-market, that's a return on equity which is expected around 14%. So our 8 to 10% is actually something which we believe is in a modest space. And that's the reason why we are still believing that we deserve to have those returns and that it should be a fair market. And looking back at the last years, we clearly see that this has not happened. Nevertheless, and this brings us now to the point where we say, like, where do we actually stand at this point in time? We have seen the losses. We have seen no returns on the capital markets. And at the same time, we're having shareholders' expectations on the industrial side as well. So from that point of view, we are seeing this as a very particular situation. Yes, we are in a hard market, but we are in this together, right? And together is a really important piece in this equation, because it's not us, the insurance companies, against the clients or the brokers. No, it's really we as an industry have to find a solution for the situation we're in. And this is a multi-dimensional situation, which means like the situation we described on the carrier side, but also a situation you are facing as clients, right? COVID is just one thing, but at the same time, you're in the midst of a structural change in some of the industries, being it technology-driven, being it by new competitors. And now also the situation with COVID. So you are in a situation where you actually need reliability, when we are actually predictability. But from an insurance perspective, if we look at the last 18 months, I think we see a significant change in the behavior of the markets. Being it, we are increasing rates, we're reducing capacity, we're reviewing our wordings, and this is causing a certain stress on your side as well. But we need to find a solution which works for everybody. So we need to provide a solution which enables you to continue driving your business. And that's where we're actually here for. And if you look at HDI, we've been founded by the industry for the industry. And our goal was always to support the industry in their endeavors. So we are still here to support you, but we also have to have a fair chance to go through this market stage. which means that we need to optimize our exposures on our side, as well as to get a fair price for the exposure which we're actually taking on our balance sheet. And I think this is a situation which is now really challenging, because it's creating a situation where there seems to be a conflict of interest, but at the end of the day, I believe we all are in the same boat. So we have to find a solution for it. And it cannot be that on one side, we as insurance carriers really stress too much what we need, but at the same time, we also expect some understanding from your side. So for us now, the situation is a time period where we need to work very closely together as brokers, as clients, as carriers, to find the proper solutions which work for everyone. Which brings me a little bit into now where we're going as an industry. And there's a post-COVID situation, right? And I think solving the situation over the next months, particularly on the upcoming year, is one item. But beyond that, you are going in a new area which is driven by technology, and where you have changes in your markets, with your clients and everything. And for us now, the question is, when we have overcome the situation with COVID, how can we still continue to be a reliable partner for you? And I think this is something which starts now. It's not in 3 years, in 4 years. It starts right now. We need to be reliable for you. We need to be predictable for you. And we need to start working on solutions which you can use to be innovative, to drive your business. And I believe, considering all of those elements, being in this market, we're in this together, right? And we need to find a solution. So yes, the hard market is here. Yes, we need to find a solution for it. And yes, we need to still support you in going forward.
Okay, thank you very much indeed, Mukader, for that insight. I'm now going to turn to Jochen, obviously from Ecclesia Group. It'd be interesting to have your point of view on how you characterize the current market situation. Would you say that we already have a hard market, or is that still to come?
Thank you, Alex, and guten Morgen, everybody from Germany. We're certainly in a hard market, but to me, actually, it's not that bad. It should bring out the best of all of us. And as we said, as Sarma said, in prior years, it shows the quality of the risk manager, it shows the quality of the carrier, it shows the quality of the broker. So yes, it's hard. Yes, it's getting more expensive, but it's also it's a bit fun. In previous years, insurance buying was more about cost cutting only, and we brokers say everybody can do it, but now not everybody can do it. So that is actually very good. And in also prior years and prior discussions, a lot was said that, oh, what you really need a broker, there will be an algorithm, there will be Google, there will be Amazon. No, now the transaction matters again. That's one thing, however, and my partners, friends on the carrier side explained it very well, what is the market like. The only thing I like to point out, and maybe even disagree a bit, the carriers are not the victim of any circumstance. So the prices that have been there before and that will be there going forward are the match between supply and demand. And it was an oversupply and demand was there, so the price was low. And now that is changing. And one thing also it was said about captives. I am not that worried about captives. First, we need to advise our clients about captives, that's for sure. However, many will find out, I think, that insurance as we know it is the most efficient form of risk transfer. There's nothing less efficient than insurance. So we have to continue, as Henning said, to provide a good value proposition, and so that insurance will be bought, and that's up on us. And another angle to it also is the whole discussion about the market, and now also COVID, which obviously is a tragedy, a global tragedy, is a bit too negative. We are all in an industry which touches lives of people, touches corporations on a daily basis. So we can really now shine, if you will, and create this positive touch point by the claims management we do. We as brokers, but same applies to carriers. And that is, I speak from German perspective now, the carriers in Germany, especially when it comes to pandemic business interruption and closure of sites, have not been too easy to work with. A very good exception of that, Mukader, is HDI. They've done very, very well. Other carriers, not so much, and I think they are missing a boat here. But overall, yes, the market is hard, but yes, we should all see this as an opportunity to show everybody, risk managers, their CFOs, we as brokers, our clients, we should show everybody how good we are and which value we bring.
Okay, vielen Dank. Thank you very much indeed, Jochen, for that more uplifting analysis. You're watching our virtual seminar. Please, if you want to challenge any of our speakers with questions, in about 20 minutes, I will be relaying your questions. So please submit a question by clicking on the submit question part, and I'll be more than happy to ask your questions on your behalf. Now let's turn to Nick. At Marsh, you have obviously a wider geographical role, and you're probably in constant touch with colleagues in different territories. That's why I think it would be interesting to see how you perceive the insurance market in Europe when you look through different lenses, global, regional, or also, of course, country specific.
Thank you, Alex, and good morning to everybody. Yeah, I mean, obviously, as Henning and Mukader and Jochen referred to it, we are in a hardening market. If we take a look through a global lens for a lot of the sort of reasons that have been described already, pretty much throughout the world, we're seeing hardening of rates, we're seeing reductions in limits, pretty much across the broad sector, although particular focus around property, D&O, and to some extent casualty. If I take a little bit of a global view, sort of moving away from continental Europe, certain territories, in particular Asia Pacific, UK, US, have been hit harder than we have so far in continental Europe. And that's really sort of as a result of some of the comments you mentioned, significant increase in cat losses, wildfires in Australia. Obviously, the hurricane season is one of the record seasons that we've had so far in the US. Plus as well, an increase in litigation and lawsuits have really sort of put significant pressure on pricing. And as I mentioned, in some cases, reductions in limits as well. So whilst obviously in continental Europe, we are certainly within a hardening market, certainly within the property, D&O, and to some extent liability. From a rating perspective, it's not yet at the same levels that we're seeing in other parts around the world. One of the real sort of drivers to me, and I think one of the sort of the strengths of continental Europe as a marketplace, is actually the very strong domestic market we also have as well, that to some extent are able to sort of mitigate the increases that we're seeing, bring some level of competition, and perhaps to Jochen's point as well, and to Henning's point, creates an element of competition. And in parts of the world like Australia, where they're quite heavily reliant on international markets such as London, that don't tend to have that sort of broad domestic marketplace in Europe. In some sectors, not in all sectors, but certainly that's been seen as an opportunity to mitigate, as I say, some of the increases that we're seeing. I think certainly as we continue into the rest of the year and into early next year, we will continue to see the hardening. But as Henning mentioned, 50 billion of new capital coming into the market will at some point have a positive impact. Where, it remains to be seen. Hopefully as much as that as possible into continental Europe, but that certainly will bring opportunity. I do see as well, we're seeing more local carriers, domestic carriers starting to use this as an opportunity, primarily because they haven't really been hit by the same sort of global losses that have been mentioned. Equally as well, reinsurance has quite a significant impact on this. And that's one of the core drivers in terms of perhaps the volatility, the uncertainty, is a lot of markets at the moment are sort of waiting to see how their treaty renewals will impact the direct side going forward. And that's equally sort of requiring some insurers to perhaps be a little bit sort of hesitant in terms of where they can deploy some of their capacity until the treaty sort of renewals are completed. So there's a lot of different factors that we're seeing around the world. Certainly the hardening market is here to stay. Positive signs in other parts of the world, in Latin America, Middle East, Africa. Yes, it's challenging, but there are markets that are there. It's really sort of the multinational, particularly clients, unfortunately, with US exposures that are being hit harder than others. But I'd agree with Jochen. I think this is certainly an opportunity as well. We are working with clients in terms of how we can sort of look at alternative solutions to mitigate pricing increases, really to sort of prioritize and look to see what the real true limits are that are required, making use of captives where it makes sense, reviewing retention levels as well where it makes sense. You know, one thing I do believe, and yes, it is something that we are all in this together, of course, but equally, let's not forget, is an incredibly challenging economic environment that, in particular, clients are facing. And on one hand, it's understandable that perhaps from an insurer perspective, there needs to be a return on profit. We need to see an increase in rates in certain sectors that perhaps been hit harder than others, particularly through losses. But what does concern me in some areas is that we're seeing sort of systematic increases irrespective of perhaps the individual clients' exposures and losses. And that's something I do think we need to work more collectively with the markets, working with clients to improve how we perhaps present the client terms to the markets, and for the markets in turn to recognize that perhaps there are clients that have a good loss history, that do have exceptionally good risk mitigation controls, and perhaps shouldn't have to be sort of faced with the same level of increases or challenges that others are in other sectors that are sort of more impacted. Thank you, Alex.
Great. Thanks very much indeed, Nick. And last but by no means least, let's go to Laurent. Bonjour. So you're an insurance manager for an organization, ArcelorMittal, obviously has a huge global footprint and multiple insurance needs. So I'm sure that you've gone through almost all of the hardening market's impacts we've just heard about. Perhaps it'd be interesting if you tell us a little bit more how you have been impacted and what kind of response or strategy you've tried to develop to mitigate this impact.
Yeah, thank you, Alex. And good morning, everyone. I'm the last one, but I still have to say good morning. Yes, in terms of impact, I would say I would like to highlight two main dimensions. I would say the first one is, of course, everything linked to the insurance technicalities. So basically, as you mentioned in the introduction, we have two alternatives, which are to buy less or pay more. And I believe, as always in life, that the truth should be somewhere in the middle. So like Mukadea mentioned that also, we call that the triple crunch. So we have a price increase, we have a capacity reduction, and we have underwriting restrictions. So even though we insurance managers, we understand the dynamics in the insurance market. I mean, that's our professional duty to try to find a strategy to respond. And from the insurance technicality side, there is no magic, and we are a bit back to basics. So the first significant change we have seen as an impact of the hardening market is a much more dynamic insurance management process, meaning that we, instead of, and that's basically through our captive and our self-insurance and retention capabilities. It's really how do we position ourselves in the design of our program. The usual way is to self-finance, say frequency. That's the basic way. Now we see more and more our captive, and we have to develop the tools to assess that properly. Going up, meaning that we remove sub-exposure in the towers, we underwrite or we self-retain, layers in the middle of the towers because they are completely overpriced. And that's something we needed, of course, to develop, as I said, the right tool to be able to assess that and suggest the proper decision to be made by our management. The second change I have experienced is a much stronger focus on the risk appetite of the organization. Because, you know, now we need to be able to communicate with our management about, you know, what does it mean to leave an exposure uninsured, or to have a reduction in insured limit because the capacity is going down. What are the potential impacts on the financials of the companies, and what are we ready to retain? And I mean, because of the hardening market, that's something we really have to dig into the details and be sure that we and our management have a clear understanding about what it means if we decide to self-retain something, or if we decide to not insure at all, you know, some sub-exposure in the program, or even to drop insurance for some lines. And the last technical item is once again back to basic. It's that we needed to develop a much more sophisticated approach in terms of total cost of risk, because for the last 20 years, I mean, yes, insurance has been a very efficient tool to finance the consequences of risk, among other tools, but now we see that it's becoming less cost effective, at least for organization. And basically our speech to the top management is to say, listen guys, the total cost of risk will increase. There is no doubt about that. Now what we need to do is really to see how we spread the increase between the retention and the cash out premium. So meaning, you know, because, and now we have very interesting discussion about, you know, what does it mean to increase a cost that will only materialize if you have a claim? Because it's a kind of, you know, all or nothing, but I mean, we cannot of course go with the rule of thumb. So we needed to develop a more sophisticated approach to be sure once again that we are able to explain why we believe and what is the right balance between increasing retention and which is buying less, and increasing cash out premium, which is paying more. And that was my initial comment about the truth should be in the middle. And that's something we have really developed over the last, over the last 2 years, I would say. So that's the technical part of it. And I would say the second dimension I would like to highlight is what I call the partnership paradigm. You know, insurance has been told for decades to be a people business, to be a business where partners may have open discussion to try to solve issues. And what we have experienced is a bit of deterioration in that paradigm. And the first item I would like to mention is what I would simply call the behavior. You know, from we as clients, you know, we face underwriters, and I have to say that we are talking, unfortunately, only through video conferences, with people that are much more aggressive than in the past, and who look much more focused only on their insurance company's P&L, which once again is understandable. They are under significant pressure from their management. But they seem also to have lost control to the C-suite. You know, that now chief underwriting officer may make decisions about, you know, we stop writing that line, or it's a 35% price increase, no matter who we are talking to. And we face people that are not in the driving seat. You know, in the past we were able to have discussion with underwriters and people responsible for the account, and that lead, I believe, because of the pressure they have. And I mean, the relationship with the client, we have to confess, is not the same as before. The second thing in the partnership is for me really important is the servicing quality. What we experience, you know, that the servicing quality is going down. You know, people always believe that insurance, it's only about premiums and claims, but you know, I believe 75 or 80% of what we do, at least in large organizations, it's a process. I mean, it's international programs, it's flowing premium, it's reinsurance contract, it's putting the captive at the right place. And we need our partners, of course, to support us. That's administration, cash flows, premium, and whatever you may think about. And of course, in large organization, I mean, every day we have an operational issue to be solved. Be it a paperwork in South America, be it something in North, whatever. And what we see also right now is that the people are much less flexible, And once again, because they seem to be, they have one target. I don't know if within insurance companies you have, big catchphrase on the wall when you enter the meeting room that, what we need to do is increase premium, restore our P&L. And once again, we fully understand that. And we are not crazy. I mean, we have seen the P&Ls of insurance companies. And like the servicing is at the second place now, which for clients, as I said, is also important because that's the daily business, the premium and claims, that's renewal, that's ensuring our strategy and cover is in line with our risk profile, but the daily business is back in middle office, and we need people to cooperate with us in a much more positive way for addressing these questions.
Perfect. Okay, thank you very much indeed. Merci beaucoup, Laurent. We've actually got quite a lot of questions, so if I can ask you for very brief answers, but please feel free to answer any of the questions which specifically interest you. How do current loss expectations compare on business interruption cover in the EU, the UK, USA, and Asia? That was one question which was sent in. Who would like to take that?
Yeah, so maybe I just start. I'm not quite sure I fully understood the question. I tried to respond. So I think what we see in the current losses, basically with business interruption, is the interdependencies in the world, and I think it's crystal clear in the combination of COVID. That's a challenge. That's a massive challenge, and I think has been probably as well an underestimated challenge in the past, and will certainly lead us to, and will lead the industry as well, to rethink interdependencies when it comes down to business partnerships and the global setup. And I think that's a question of one, from a loss perspective, that's obviously different than we expected, but more so important from a client perspective to make sure, obviously, that the exposures are under control. And that's from my point of view.
Anybody else like to take up that point, or should I go on to the next question? No, you all seem quite happy with that. This is a question specifically about the UK. How big is the impact of Brexit on the overall market hardening in general? Nick, maybe.
Gosh, I don't actually think it's having a specific impact on the hardening market, to be honest with you. I mean, there's probably the only real connection really is obviously the additional cost that's been incurred on the market in terms of obviously repositioning their capabilities from the UK into continental Europe. That clearly comes at a cost. To be honest, I think it's an opportunity in Europe. I think, in terms of the marketplaces that we have, the dynamics that we have, there's always going to be a need for us to use the London market with the strengths that it brings. But I do think actually from a market perspective, it equally brings opportunity. So I think we're all sort of collectively still sort of trying to work out what the hell is going to end up as a result of the negotiations, depending on which side of the fence you sit. It's an unwanted distraction to what already is a challenging market. But frankly, I don't think it's sort of a core driver, to be honest with you.
Thank you very much for a diplomatic reply. Anybody else want to talk about Brexit, or should we move swiftly on? Another question here. Brokers seem to be making ever larger profits. Is that normal, somebody asks, especially when considering insurers are actually losing a lot of money? How would you react to that comment, which has just come in?
Yes, exactly. Thank you. I have not seen an carrier that's actually making losses. There's a large carrier in southern Germany which records 4.5 billion profit in the first 6 months. So I think that's the whole discussion about the hard market and COVID and so on. COVID is not a capital event. That is very, very important. It's a profit event, earnings event, and decrease in earnings, but not loss making as a whole for the whole carriers. And for the brokers, I'm not sure all the brokers making record profits. I just know the profits of my company really, and one of the quoted brokers. Profit is really a result of the value you bring to the client. And if you bring value, you're profitable. If you're not bringing value, you're not. So ultimately, it's for the client to decide, and we are very happy to provide our clients, and I'm sure Nick is with Marsh, their clients with ultimate value that in the end brings profit.
Yeah,
Anybody else want to, would you like to comment?
I mean, I agree with Jochen on that. I think it's around the value, and I will not necessarily say that sort of profits from the broking perspective are driven by the market specifically. Marsh, like others, we have to change our approach. We have to improve around our efficiency. Equally, sort of changing our behaviours to look through more of a consultative lens as opposed to perhaps a pure transactional lens. So I think that means of us adapting. And with that, yes, if there's opportunity where we're adding that value, we can sort of generate the revenue to support that, then we'll do so. But I think it's equally just a question of sort of all of us having to adapt to the current market conditions as appropriate.
Okay, another specific one here. Motor insurance is going down. How do you expect other P&C lines of business to respond in the current markets? Anybody want to take that one on?
Well, I think it's fair to say that motor also went up the last couple of years, where the rest of the market, relatively seen, went down. Motor went up, and the first 6 months saw a decrease in loss ratio on the motor lines. So, the jury's out. How long this will last, I don't know.
I think it's a variable picture, Alex. I think country by country, depending on the specific portfolios, seeing an increase in the liability claims, which could start to see a bit of a move upwards on the motor side, but it's one of those lines that I think is really sort of, country by country at this stage anyway.
Okay, to what extent do you feel excessive US liability claims influence the profit opportunities in the EU? Vast question. Who would like to take that one on?
Well, I can take that one on, being responsible for liability. So maybe I touch base on what Jochen a little bit earlier said. Yes, a lot of the insurance companies as a conglomerate still make money, but if you look at the portion of industrial and commercial lines insurance, we really see that all these carriers have not made money over the years. So from that point of view, I think it's a kind of a mixed picture, but I would agree with you on an overall basis, there are still some groups which make money. That is. Having said, now turning back to the liability question, obviously, particularly in the commercial lines business, the influence of the US litigation on prices is significant, right? If we see verdicts in excess of 200 million for a motor vehicle accident in the US and all kind of other social inflation verdicts, then we obviously have a challenge for globally acting companies. So from that point of view, yes, there is an impact of the US litigation on the EU, particularly for those companies which have a US exposure. And looking at our core segment and companies who are internationally active, I would say like the majority, 80 to 90% of them have a US exposure. Concerning that point, the impact of those developments have a one-to-one effect on the way we assess also European risks with a US exposure.
Perfect.
Maybe just to add to this, because I think it's important from a carrier perspective. So obviously you have this very specific situation, which, as we just heard, will have an impact on European carriers and European clients as well. But you have at the same time as well substantial reserve increases and impacts on long tail books as well outside of the US. So I think you have this overall mix, which to distinct then how much is dependent and how much is driving what in which territory is difficult to say, because you have basically this as an overall impact.
Okay, I have a question specifically for Laurent around COVID, the global impact. What would you say about that? And also, if you could tell us how your organization is specifically coping and assessing and quantifying catastrophe risk. For example, do you have third parties involved? I think it'd be quite interesting, Laurent, if you tell us about that.
Yeah, okay, so but that's two questions. I mean, let's go for the first one. So COVID, I would say COVID, from what we are talking about, in respect of the hard market, as two major impact, I mean, from my perspective. The first one is, if I go back to what I was saying about, the partnership issues we may face with insurance carriers, I believe COVID has been really unfortunate and has really not helped, because we have not been able to talk about that with our partners. And so when I was talking about, behavior and sometimes the aggressivity we face, I mean, I'm sure in a normal environment, that's something we would have been able to talk about extensively. And the usual image that, around the beer or a nice dinner, we would have solved many issues that we have not been able to solve by video conference and phone calls. I mean, it just doesn't work. With regard to COVID, my main concern is about, the near future. And we touched about that. I believe Nick talked about that very, very shortly, because my concern is that the hardening insurance market will become even more problematic in the coming months, because the problem will escalate. The point is, you have, an economic environment, and basically you have two extremes. You have the Facebook, Google, Amazon, who are doing well, and on the other hand, you have, airlines and hospitality business who are almost dying. And in the middle, everybody is struggling. And what does it mean? It means that you will have significant cost-cutting plan, and basically insurance managers within their company will be the only one to go to their management saying, guys, I'm coming with a product that is lower quality and is more expensive. And my point when I say it will escalate, so far the insurance hardening market was a problem for insurance manager, but it will escalate to the CFO and CEOs. And once again, the timing is really unfortunate, because we understand the dynamic in the insurance industry, but you will really clash with a global economic environment where it will be even more difficult to manage this, hardening insurance market from the insurance manager side. Now, in terms of catastrophe, Jesus, I could talk about, I would need 2 hours, but I believe I have 15 seconds. So yes, we use third parties to support us. We also have internal tools. And we try to, especially around earthquake, this is where we do a lot to try to understand our exposure, because we have some facilities in earthquake zone, and also with the support of insurance companies. But I believe it would be another session on itself. So we should expand that, or in the networking lounge, if someone is interested, we can have we can continue the discussion.
Perfect. Okay. We've got 5 minutes left, so I'm going to give each of you about a minute to reply to this question. It's actually quite an interesting question, vast discussion. Is it possible for the insurance business model to be sustainable for society at the same time as profitable? We could talk about it for hours, but if I could just have 1 minute of conclusion from each of you, who'd like to start off?
Well, I can go, Alex, if you want to. So sustainable means that it's a long-term partnership, right? And a long-term partnership means that it's a win-win situation for all parties being involved in that. And I think that is the most important piece. Yes, you're absolutely right, Jochen, it's supply and demand. Yes, Laurent, you're absolutely right. Our clients are in a difficult situation. So for us, the challenge is going to be, how can we find a joint solution, right, to be sustainable? Because otherwise it will not work. It will not work for the insurance industry. It will not work for our clients. So yes, we have to work this together.
Okay, who would like to attack this next?
I'll just, sorry, Jochen.
You go first, Nick. West Ham first.
I mean, to be honest, I mean, absolutely, I agree with Michael. It's something, obviously, we need to sort of look at, an opportunity for us, I think, as an industry to sort of look at alternative solutions. Totally support Dirk's comments at the very beginning about the need for us, particularly in relation to pandemics, to look at the PPP solution. That to me is an absolute must, that we need to sort of drive to give our clients the sort of protection that's required. I do think actually as well, partnership is key, I agree. I do think trust is probably the most important factor in this as well. And I do think the current sort of stress on the market, the stress on clients is kind of damaging the trust that's existed. So I think to enable us to sort of rebuild the sustainable market that it is, it is a strong marketplace, we do need to build that trust between the collective sort of partnerships that are involved. Clients, markets and brokers come to that as well.
Yeah.
Okay.
Maybe if
I think it's, as Nick alluded to, there will be a time after the crisis. And don't burn too many bridges because you will need them after the crisis. And the other thing about the sustainable model of insurance, under our current circumstances, there will always be the risk, the need for risk pooling and risk transfer. And that's what insurance is for. And to us, all of us, clients, brokers, carriers, reinsurance, and so on, I think if everybody, again, focuses more on what he and she is good at and what he and she should do, then we will be in a much better place.
Okay, let's go over to Laurent.
Yeah, I can only agree, and my recommendation to carriers would be: do not destroy your product. Because for instance, for us insurance manager, what has always been really difficult is to defend and translate and convince our management that insurance should be looked at on a long-term basis. Companies and organizations are very short-term. They look at the next quarter, the next year, but we need to look at insurance over a 5 to 10 years period. And what we are experiencing right now, it's exactly the opposite, meaning that insurance companies seem to be very short-term. It's about next year, it's about this year, it's not about a 5 years period. And so the point is, I fully agree that's something we are all in together. As I said, multiple times, insurance manager understand the dynamics. They are insurance guys, clearly understand what has been happening over the last years. But we need to go back from a very short term to a mid to long term perspective about that, because my fear is that if we deteriorate the partnership paradigm, and if we deteriorate the product of insurance, at least for what I call jumbo organization, you could have damages over the long run. And Jochen is exactly right. There will be a life after COVID, and there will be a life after a hardening market. And if the partnership and relationship is destroyed for very short-term reason, that will last for a long time.
Yeah. Okay, let's go to Henning now for your final conclusion, if you can wrap up the discussion for us.
Okay, so I agree with what I have heard from you in terms of is the insurance model sustainable? I think so, absolutely. We heard before as well that it's the most efficient way of risk transfer. I couldn't agree more. I think it is clear as well that the sustainable means as well as hey, everyone has got capital in their mind and a return on capital. So sustainable means an average return. And we all know as well that there will be cycles. So there's time where you earn more, there's time where you earn less. I think just over the cycle needs to make sense. And I agree with Laurent as well, it shouldn't be on a short-term cycle. But I think on the other hand, it's fair to say as well that we as carriers need to do our homeworks. It's pretty clear that there are a couple of things we heard before. We are not the victims of the market. I think that's absolutely true. We are not. We all did this somewhat eyes wide open, and we still need to do a lot as well when it comes down to product innovation and data and analytics and systems, where we really need to take the time now as well and get it right to make and build a sustainable business model. Thank you.
Okay, thank you very much indeed. Vielen Dank. Merci beaucoup. Thank you to all of you for having taken part in this very first virtual seminar. Thank you for your interesting contributions. It was almost like being on stage. We had lots and lots of questions, especially towards the end. Really sorry if I couldn't ask your questions. There were some quite specific technical questions, but all our speakers are now going to be available in the networking lounge, so you're more than welcome to talk to them directly there and ask the questions that you would like to ask them there. I'd just like to remind you before we sign off of the 3 workshops this afternoon from 2 o'clock to 3:30 Central European Time. The underestimated challenge, risk and insurance communication in a hardening market, that's one. Then we have reconciling ERM and insurance, getting the best of both worlds, the second one. And then finally, back to risk financing basics. What are the alternatives to insurance? And then just finally, a very important meeting we have at 5 o'clock, once again, Central European Time, to celebrate this moment all together.